Every year, Warren Buffett releases an annual letter to Berkshire Hathaway shareholders, filling his investors in on the financial goings-on at the company and reflects on the choices he's made over the years. The letters make for important reading if you want to be more like the undisputed champion of investing. In this year's note, one piece of information made a lot of investors' ears perk up. Buffett is holding cash, and a lot of it. How much is a lot for a company valued at more than $700 billion, you might ask? At the moment, a whopping $144 billion. Buffett explains that he always keeps at least 80% of his net worth invested in stocks and prefers that number to be closer to 100%. He states, "Berkshire's current 80% or so position in businesses is a consequence of my failure to find entire companies or small portions thereof, that is, marketable stocks, which meet our criteria for long-term holding." The criteria Buffett refers to, the basis of his investing philosophy, hinges on the idea of buying good companies at an attractive value. If you have a diversified portfolio, chances are you already own some value investments. If you want to hew your portfolio closer to Buffett's, however, it might be time to add more. Here's how. Berkshire always has at least some cash on hand, Buffett notes in the letter. He and his late partner, Charlie Munger, have pledged to always keep at least $30 billion in reserve. The duo want Berkshire Hathaway to be financially impregnable and never dependent on the kindness of strangers or even that of friends, Buffett told his shareholders. "Both of us like to sleep soundly," he added, "and we want our creditors, insurance claimants, and you to do so as well. Financial experts say you'd be wise to adopt a similar policy. Most recommend that you have at least 3 to 6 months' worth of living expenses tucked away in an emergency fund. In doing so, you lower the possibility that an emergency, such as a sudden job loss or a surprise medical bill, could derail your finances by forcing you to tap your investments, borrow, or run up debt to cover your losses." Buffett doesn't only carry cash to cover emergencies. He holds it for periods when he's searching for a good deal, a strategy that many market watchers refer to as having dry powder. In simple terms, cash ready to buy when sales suddenly happen. One example would be this current market correction we are experiencing. Emotional investors, if you would even call them that at all, panic and start selling when downturns happen. You start hearing statements like, "I'm moving to gold," or "I'm taking a break from the market to see what happens." These are not true investors because they bounce around from one panic button to another and are victims of the unpredictable Mr. Market. Smart investors make a profit when the market is up, down, and sideways. They simply know that buying in the dip makes smart financial sense. Doing what others are not doing is key here. This is one of the only primary reasons that holding cash makes sense other than the 3 to 6 months of emergency savings like we mentioned before. Otherwise, cash is trash and always will get eaten away by inflation. Why Warren Buffett prefers passive investing. On a basic level, you can mirror this by holding some cash and deploying it when markets or a particular stock on your watch list sinks to a target level. Pullbacks offer a nice buying opportunity for investors, assuming they kept some dry powder in their portfolio. If you went to the supermarket today and you saw that hamburgers were half off, would you run out screaming? Or would you buy 10 and stick them in your freezer? During the COVID pandemic crisis around March of 2020, how many of you wished you would have had an extra couple thousand or even a couple hundred lying around to scoop up the discounts? How many said to yourselves, "I would have bought oil stocks at those prices because look how they rebounded in a short amount of time"? How many of you actually did this? If you are one of the ones that benefited, then you already know what I mean here. There's no luck in that, just financial planning. If not, you had no reserve cash to deploy in the dip and missed out. Don't let this happen the next time we have buying opportunities to take advantage of. Financial experts constantly urge investors to keep calm and stick to the plan when situations are volatile. But the idea that short-term news shouldn't affect your long-term plans can be difficult to stomach when the short-term news is a land war in Europe amid a once-in-a-generation pandemic. When markets decline in response to global events, It's scary, and your gut reaction may be to sell your stocks to avoid holding them should they fall further. But exiting the market means that you may not be able to take advantage should stocks eventually bounce back. And historically, they always have. When markets fall, you have to ask yourself, is this a sale or the end of the world? So far, in our history, pullbacks have always been a sale. Market corrections happen about every 3 years. A sharp decline can feel jarring and sudden and unique, but zoom out and you'll realize they happen regularly. Since World War II, there have been 61 pullbacks, declines between 5% and 9.99%, 23 corrections, minus 10% to minus 19.99%, 13 bear markets, minus 20% or worse. That means that over that period, pullbacks occurred every 1.25 years, while corrections happened every 3.3 years, and bear markets materialized every 5.8 years. Bear markets last 434 days on average. Some market slides are longer and deeper than your typical downdraft. Bear markets can take a big bite out of your portfolio and see you spend longer than you might like staring down red numbers in your portfolio page. But they may not last as long as you think. The average length of the 5 bear markets since 1980 is 434 days from peak to trough, according to data from Yardeni Research. That includes weekends and holidays. Watching your portfolio decline for more than a year may seem daunting, but over the course of your life as an investor, it could be a blip. Though past performance doesn't guarantee future results, for long-term investors, market pullbacks, even scary ones, have historically been temporary. And for opportunistic investors, they're a chance to buy investments at a discount. When markets sputter, consider revisiting your portfolio and your watch list to see if an investment you like has gone on sale. If you liked a particular stock 6 months ago and you thought it was a viable company, take a look at the price now. If you liked it for $300 a share, you should love it at $100. So in closing, we recommend thinking long and hard about keeping some cash ready to buy the dip. Just because we will experience market volatility from time to time, it never lasts as long as you fear it will. Be greedy when others are fearful. I hope you enjoyed the video today. Now don't forget to like it, leave a comment, subscribe if you haven't done so, and hit that notification bell for all the latest content from the channel. Just have fun with your investing journey. Until next time, keep investing simple.